The chickens are coming home to roost with commercial real estate loans in 2024, and they're going to lay some bad eggs. Stay tuned, and I'll show you why. Hey everybody, Greg Barron, Professor of Real Estate. Thanks for joining me today on the channel, and we're going to talk about those commercial loans that are coming due. You're going to want to stay tuned because I'm going to show you some charts of banks that are actually loaded up with these commercial real estate loans. And we're also going to talk about some maturities of securities, that kind of rhymes, that's going to happen also this year and into next, and how doubling up on both of those might be a double whammy to commercial banks and regional banks especially that are carrying a lot of this debt. You know, I've said this term all of my life, the chickens are coming home to roost, and I really never knew why I said it until I looked it up. And basically it comes from a poem back in 1810, which means your negative actions bring consequences later on. Well, I had chickens when I grew up and even into my adult life, and I do know that they do roost. They go out and poop, they come back and they lay an egg, they go do the same thing over and over again. Those are nasty animals if you have to take care of them. But in the banking sector, I can tell you that the chickens, i.e. the commercial real estate loans that they lent out 2, 3, 4 years ago, are now coming home to roost in 2024 and 25. So I'm going to discuss with you a little bit about what that means. And I'm actually going to give you some content that is specific to charts of which banks are carrying the greatest amount of commercial real estate risk as far as their assets are concerned. But before we go into commercial real estate loans, it's really important that you understand effectively and fundamentally how a bank operates. It's there to create debt. Debt creates money. It works off of an interest spread. It basically has a return on equity that is highly levered. And when I say highly levered, I studied this when I was studying abroad in financial accounting and corporate accounting. I actually did case studies on banks that failed because of their high leverage that they held. Basically, you can have $1 of deposit and you can loan out 90 cents on that to other users that need it. So it's very highly levered. True, the Basel III and all of these other constraints that the government put on them tried to constrict that reserve and constrict the amount of money they could lend to create some kind of buffer. But the fact is, banks in and of themselves are very highly levered institutions. They're similar to those that are heavy on assets. Airlines are highly levered. Utility companies are highly levered. PE companies, when they do leverage buyouts, are highly levered. And the fundamental premise behind that is you earn more return on your dollar the more debt you carry. So there's a lot of companies out there that make a higher return on equity, but they become highly vulnerable when there are disruptions. Banks are no different. Disruptions and cycles in the economy, things that we're experiencing right now when interest rates float up and they basically lent out long-term money. Let's just say, for an example, they've lent out long-term money on a mortgage for 5%. They were only paying 1% on their deposits or CDs. All of a sudden, the Fed fund rate goes up and they're having to keep their deposits in-house. So now they're having to pay 4.5% on those same deposits, but they've lent this money out long-term for 5%. Their spread goes from here to here, which causes issues. Now you compound that with default on the loans, and all of a sudden you've got a liquidity crisis with banks. That's a very simple explanation of what I'm about to show you is happening right now and will start to come due again at the end of 24 and into 25. We've got close to $1 trillion worth of commercial real estate that's rolled over from 23 into 24. Call it kick the can, extend and pretend, that's coming due now, and they can't do anything else about it. I spoke about this last week. But this is nothing new. This happened in the 1980s with the S&L crisis. Those of you are old enough to remember, and some of you profited from it, the savings and loans basically had very limited governance they were able to make long-term mortgages on short-term money that was deposited. And what happened? Inflation spiked, interest rates went up, and over 1,000 banks failed in the 1980s, creating the Resolution Trust Corporation, basically funded by the government, where all of these properties and all these commercial multifamily properties, the same thing happened. The valuations went down. They had to default on their loans. The banks couldn't keep them as real estate owned anymore, and they had to take them off their books, and the banks failed. In 2008, a similar thing occurred in the mortgage crisis, a subprime mortgage crisis. So, it reminds me of the same term that I mentioned before. As a dog returns to his vomit, so does man return to his folly. We actually return to the same folly. This time, there's a little more support in the system to weather it, but make no mistake, there are going to be some more bank failures. I'm going to show you a graph and a chart by Florida Atlantic University, which basically follows this. They follow two basic sectors. One is the hold-to-maturity securities, and also the commercial real estate loans as a percentage of the Tier 1 capital or equity of banks. These are sobering. So the primary reasons that the banks failed last year was not because of commercial real estate loans. It was because of their mix of securities that they had in their banks called held-to-maturities and available for sale. That is still very problematic because interest rates have not come down, which has forced banks to hold on to those securities and not sell them. The trouble is that their net interest margin has been squeezed, which causes liquidity problems. Now, that's one problem. The second problem that's now coming home to roost is the commercial real estate loans that now have due dates and the banks have to do something about them. The valuations have come down and they can't kick the can anymore. So here's two basic websites that I want to show you from Florida Atlantic University that studies these two trends specifically, that basically shows the vulnerability of banks and why we need to watch out for them. So this first one is the unrealized losses on investment securities. So the university has done a great job in collecting information and putting it together to show the vulnerability of some banks as it relates to these securities that they're holding, which if they had to sell them would take significant losses. So this chart I'm going to show you from Florida Atlantic University is really quite sobering if you spend some time looking at it. And anybody can look this up. I'll put it on my link below if you want to spend a little more time looking at the website. But this is the held to maturity and the available for sale securities in relationship to their capital. And that sounds a little difficult, but when you actually look at this, let's take the number one bank that has the most amount of vulnerability and exposure, which is Union City Savings Bank out of New Jersey. It has total assets of $1.4 billion. It has a potential loss of $260 million if the held to maturity shares for some reason had to be liquidated today. They only have a $151 million in capital as it relates to their Tier 1. So that means if you take the difference of $260 million from $151 million, this bank would be illiquid. Look at number two, Citizen State Bank out of Texas, my home state. Again, $1.4 billion in assets, a Tier 1 capital of $163 million, but they have approximately $198 million in securities held to maturity or available for sale. And if for some reason they had to liquidate, they would be underwater. These are the kind of things that you don't have to mark to market right now. So you could have these banks holding these long-term maturities, but the accounting rules say you don't have to mark to market, especially the held to maturity. But if there was a run on the bank, if there were some losses and they had to liquidate those for any reason, they would settle a loss. I hope this makes sense. But this particular website goes down the list of all of these banks, and you can see that many of these banks are over 100%, which means they would have more losses than capital in the bank. Now, let's go to the commercial real estate loans. This same university publishes an equally sobering chart and a graph which shows total commercial real estate exposure to your total equity or total capital of the bank. Again, extremely sobering. Banks that are extremely vulnerable to commercial real estate risk if there was foreclosure. So let me explain this, and it'll be very simple. Take the first one, Dime Community Bank out of New York. They have total assets of $13 billion, but they only have a total equity of $1.4 billion. However, their total commercial real estate to total equity is 653%. Now, what does that mean? That means that their total loans in commercial real estate is $9.2 billion. However, their total equity is only $1.4 billion. Are you kind of getting the flavor of this? If there is all of a sudden a need to foreclose on these commercial real estate properties, they're holding $9 billion in commercial real estate loans with only $1.4 billion in total assets. The next one I want to take a look at a little bit deeper, which is Bank of the Ozark. It's a bank out of Arkansas of all places, and I'll give you a little more insight into this bank because this one's interesting. $36 billion in assets, $5.2 billion in total equity, but $32 billion in total real estate loans. That means that they are subscribed 620% over their equity in commercial real estate loans. This particular chart shows you the extreme vulnerability of banks that need to be watched because of their exposure to commercial real estate. So before I leave Bank of the Ozark, let me pull up a couple of interesting articles that were written about them in the last 3 or 4 months. This article just came out in the last couple of days. It says, South Florida condo sales plunge as costs rise. Now, I'm going to make a point about this, and how does it relate to Bank of Ozark in Arkansas? Hold on. A tropical storm may be developing in South Florida condo market where a steep drop in annual sales coincides with rising homeowners association fees and skyrocketing insurance premiums. It goes on to talk about how condo sales have really dipped in South Florida. Before it was a shining star. Now it's really getting soft. Now let's go to article number 2. This came out July the 14th, fairly recent. Bank Ozark finances risky bet on Miami glamour. Shares in Bank Ozark, a mid-sized U.S. lender with century-old roots in rural Arkansas, plummeted 20% in May after a Citigroup analyst questioned its increasing exposure to troubled commercial real estate. And it goes on to say, the Ozark name appears on more large deals than any other real estate lender in Miami, the biggest region in its portfolio by dollar value, with more than $4.7 billion in 38 loan commitments just in South Florida. So I'm not saying the sky's falling for Bank Ozark, but what I would be looking at is their exposure to commercial real estate, the geography of where those loans are, and the value of those loans to total asset. It's fairly sobering when you look at it. Take a look at those if you have time. It's very interesting. It'll be interesting to track, and maybe we'll revisit it more on our channel as the months go by. So I don't want to end on a negative note. I'll end on a positive note like I did last week. with every disruption, there are going to be major opportunities, and you need to be ready. There's a lot of us out there that are fairly excited about this transition that's going to happen. So, as always, educate, evaluate so that you can ultimately execute to create your own personal wealth. Thanks for watching. Hey, and if you're enjoying the channel today, reach out to me with some information you liked for me to discuss as it relates to inflation, banking, and especially commercial real estate. And as always, be sure and like and subscribe.